This is Macro Horizons, episode 340, Navigating Normal, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of September 8th. And as the BLS dust settles and the Fed's blackout period commences, we're looking forward to a little respite from the rhetoric. True R&R. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the holiday-shortened week just past, the biggest piece of new information came in the form of August's payroll report. Here we saw a disappointing headline print of just 22,000 jobs added in August. That followed the 79,000 added in July and was well below the 75,000 consensus. On an unrevised basis, it was the lowest headline print since October 2024. This also brought the three-month moving average to just 29,000 from an unrevised 35,000. Included within this data, we also saw an as-expected increase in the unemployment rate, which reached 4.324%, the highest since October 2021. Wages were relatively benign, with average hourly earnings up just 0.3%, matching the consensus, and bringing the year-over-year pace to 3.7%, which was, for all intents and purposes, back into the pre-pandemic range. Now, the response rate for the establishment survey was relatively low, coming in at 56.7%, making it the second lowest of the year and increasing the potential for downward revisions going forward. The question has quickly become, is the employment market under so much pressure that the Fed should consider cutting rates by 50 basis points? We're not in the 50 basis point rate cut camp, although we're very cognizant that the upcoming BLS benchmark revisions on Tuesday, as well as the CPI-PPI combination next week, will provide further context for precisely how restrictive monetary policy has been, and therefore how quickly the Fed should consider lowering rates. We will be in the Fed's blackout period, so in the event that the combination of those two data points does put a 50 basis point rate cut on the table, we would expect to see that communicated indirectly from the Fed through the financial media. This certainly wouldn't be the first time that Powell's Fed has used that particular communication channel, and frankly, it would seem prudent in an effort to avoid any disruptive shocks. Assuming that we don't get a 50 basis point rate cut on the 17th of September, the debate then will be how much the Fed is willing to signal for October and December. Based solely on the August payrolls print, there's a strong argument to be made that the Fed should prepare the market for another 25 basis points in October, as well as another 25 basis points in December. This is relatively consensus at the moment, which ultimately puts the focus on the August core inflation numbers to justify messaging cuts at both the October and the December FOMC meetings.
Well, ahead of the payrolls report, we had no shortage of important information for the Treasury market. ADP, ISM, JOLTS all played a marginally, or maybe more than marginally, greater role in dictating the overall sentiment on the path of the economy and the health of the labor market, if only given the fact that there is a growing skepticism in the accuracy or maybe even validity of the official jobs numbers from the BLS. What this netted to, at least ahead of the jobs report on Friday, was an undoubtedly bullish week in the Treasury market that saw 10-year yields pull back from the top of their trading range that we probed at the end of last week, and move to and through resistance we had been tracking at 4.18, as it's become clear that the combination of changes at the Fed, worry about the labor market, and moderating concerns around the inflationary impacts of tariffs has translated to a greater comfort in owning treasuries at these levels. There's also a positional argument to be made, as coming into this week, given what was always going to be a heavy corporate issuance slate, there was almost certainly an underweight in duration that then in turn had to be covered, and while the curve has managed to retain a great deal of its steepening progress, our more bullish outlook on treasuries over the balance of this year found solace in the price action in the run-up to the jobs report.
And in the wake of the employment report and all of its obvious implications, we look forward to an interesting week ahead in which the Fed has entered its period of radio silence, but we still have two major macro events on the horizon from which investors will attempt to derive some type of forward implications for monetary policy. Perhaps the most important will be Thursday's release of core CPI. Here, the market is expecting a 0.3% increase, but we'll argue that the more important details will come in the form of the supercore measure and the core goods ex autos. Recall that in July, core services surprised stronger, while core goods came in relatively benign. This is in contrast with what was viewed as a prevailing risk that tariff pass-through would drive core CPI higher. Now, if we happen to see a repeat of that dynamic, that becomes a bit more troubling for the Fed. The other major event that occurs during the Fed's blackout period will be the BLS benchmark revisions on Tuesday. This could easily recast the market's perception of the prevailing labor conditions with a material downshift. As it currently stands, the market is anticipating a downward revision for the reference period in the range of negative 600 to negative 800,000 jobs. On net, we'll argue that this will contribute to the odds of an October rate cut rather than be instrumental in setting expectations for September or December.
And frankly, at the risk of brushing off what's going to be the Fed's next cut in a few weeks, the question really has shifted from what's going to happen in September to what this next leg of the easing campaign is actually going to look like. October and December's meetings are obviously critical in that conversation in the near term, but it's also important to consider what's going to be laid out in the dot plot in 2026 and how the evolution of the labor market is going to inform not only how quickly the Fed wants to start bringing rates lower again, but also what the finish line of those cuts is going to look like. Does the Fed want to leave monetary policy in restrictive territory? Is trying to get back to as close to neutral as possible the goal? Or is even a degree of accommodation warranted in the event that we see a truly significant erosion in the labor market? The last of those scenarios and a return to accommodative territory is probably unlikely at this stage, given that, sure, the labor market is softening, but in aggregate the economic data is hardly pointing to an impending aggressive slowdown in the economy, and when taken with the still present, if not necessarily as severe as initially feared, risk to inflation as a result of tariffs and as a result of a less restrictive monetary policy backdrop, all of this begs the question, and Waller touched on it in his comments earlier this week, does what we're expecting will be a 25 basis point cut in September necessitate another 25 in October, December, and 25 thereafter? Or is another 25 basis points going to precede a period of data dependence, wait and see, and a quarterly cut cadence? Will it be by 25 or 50 basis points? That's really become the question on investors' minds now that we know that the Fed is in fact going to be cutting this month.
And it is an interesting backdrop because I wouldn't be surprised to hear Powell attempt to message that it will be a meeting-by-meeting decision as opposed to indirectly committing to a forward series of rate cuts. That being said, a quick glance at the futures market shows that investors are looking for policy rates to bottom at 3% next year and effectively be held steady thereafter. We'll argue that that's probably the least likely outcome because it implies a soft or, frankly, no landing scenario in which the Fed doesn't need to shift into truly accommodative territory. And it also implies that the Fed has moved past the risk of another upside surprise on the inflation front. Taking a step back, we'll be quick to acknowledge the fact that the real economy has remained resilient overall, and even as we're seeing some weakness on the labor front, real GDP growth is still positive, although there is this lingering uncertainty regarding how the trade war will ultimately flow through to the real economy. But as long as equity valuations continue to hold and the wealth effect drives consumption for the upper quartile, it's difficult to argue that there's a recession brewing in the very near term.
And while there might not be a recession brewing in the near term, the discussion around the labor market makes next week's revisions all the more important in determining the Fed's interpretation of just how restrictive monetary policy is. Clearly, rates haven't been high enough to deter stocks at all-time highs, but if, after next week's revisions, in the event that they are meaningfully worse than expected, which will call below that 800,000 figure that you touched on, Ian, that means that over the course of the last 12 months, maybe, in fact, rates were a bit further into restrictive territory, and the damage done to the labor market was more pronounced than was originally assumed to be the case. The irony comes via the White House's pressure on the Fed and the fact that in the event we do see revisions that confirm the labor market was in a much worse off place over the past year than originally thought, then President Trump's criticisms of Powell and the appropriateness of the level of rates may in fact have been warranted. And while, as our pre-NFP survey results demonstrated this week, the Fed was probably going to be cutting anyway, that certainly won't prevent the president from saying, "I told you so, Powell."
This does bring up the question of central banking independence, given what we've seen in Washington, D.C., the actions against Cook, and what this could all imply for true Fed independence. As it currently stands, as you point out, Ben, the economic data has finally been developing in such a way to justify rate cuts. So to some extent, the Fed can say with a straight face that it is following through on its dual mandates while not giving in to political pressure. Now, it's unclear how compelling that case will be in 2026, but for now, we'll argue that true central banking independence has not been fully eroded.
And given we will get no Fed speak next week ahead of the meeting, let's not forget there will be another round of Treasury supply with 3s, 10s, and 30s, offering the latest assessment of demand for the long end in this new issuance paradigm. It's obviously not new information that Secretary Bessent is committed to keeping long end auction sizes unchanged for the foreseeable future, and that in turn is going to mean that bills are going to do a larger share of the heavy lifting in terms of funding the deficit. While auction sponsorship so far this year has generally been solid, we're left to consider how the latest yield moves and the fact that we've seen rates drop back to their local lows might impact the willingness of investors to buy at these levels. Now, softer auction results next week wouldn't necessarily imply a shift in the outlook in terms of issuance and imply a more systemic softness in terms of auction demand, but rather there's been a reasonable amount of buying that's taken place over the last week or so, and especially as it relates to 30s, clearly the 5% level has been enough to entice buying interest, at least in the secondary market, and so what remains to be seen is if after the recent rally, 10 and 30-year yields are still high enough to bring in that buying interest, with of course the liquidity benefit of the auctions as well.
And clearly the steepening bias has been very thematic, and while 5% might represent a ceiling of sorts for the long bond, that does not mean that the curve steepening cannot extend further. In fact, we remain biased for a steeper curve, only the primary driver will be a further rally in the front end. It's not the same bear steepening dynamic that many had been concerned about, but it could very easily still get 2s, 10s back to 75 or 80 basis points in positive territory.
So what you're saying is cyclical steepening after all.
50% of the time, it works every time. In the week ahead, the Treasury market has its job cut out for it, as it were, in terms of digesting new incoming information. First, we will continue to see the proverbial dust settle from the employment report and what that alone implies for the September 17th FOMC meeting. We will also have core CPI for the month of August. As it currently stands, the consensus is looking for a 0.3% print on core. The market is very much attuned for any evidence of tariff pass-through to end users. In this context, we'll be watching the core goods ex autos figure. Recall that in July, that number was remarkably benign, all things considered. What the surprise was in July was that the supercore measure of inflation, which is core services excluding OER and rent, came in at the highest level since January. All else being equal, this should have been somewhat troubling for both the Fed and market participants, although given the focus on the trade war, the market was quick to look beyond the supercore measure and assume that the absence of any meaningful tariff pass-through would drive the broader policy narrative during the final 3 meetings of this year. As it turns out, that was probably the right interpretation. Given the refocus on the labor landscape, PPI and CPI will be less immediately impactful for the September meeting and more likely than not simply contribute to estimates of where terminal will be in the process of normalization. For context, the SOFR curve currently has policy rates bottoming at roughly 3% in 2026. Now, while that is certainly more dovish than the 2026 dot from the SEP, we are anticipating that the updated Fed projections will simply be marking to market the Fed's estimates versus what the futures market is suggesting. Said differently, we're biased to see a lowering of the Fed funds projections provided by the FOMC. That certainly is relatively consensus at this point, and we wouldn't be surprised if the combination of a 25 basis point rate cut and a more dovish dot plot was followed by relatively muted price action. The week ahead also contains the preliminary benchmark revisions for the establishment survey, and given what we saw on Friday, the market will certainly be focused on these numbers. The range of estimates are somewhere between negative 600 and negative 800,000 jobs to be taken off of the reference period. While historically this hasn't been a significant market mover in terms of price action, the recent refocus on the labor market, combined with data quality concerns at the BLS, have resulted in this particular release having meaningful market moving potential, as well as potential to refine investors' monetary policy outlook. On the supply side, the Treasury market will see 58 billion 3 years on Tuesday, 39 billion 10 years on Wednesday, and 22 billion long bonds on Thursday. We expect that the tone on the supply front will be a function of Wednesday's 10-year auction, even as we do anticipate that the 30-year is more likely than not to receive a lackluster reception, given what's going on globally with duration. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And a quick glance at the calendar reveals that technically it is still summer, although technically we are still middle age. As they say, you're only as old as you act. I wonder if we could pitch feeling 72 as a reason to receive Social Security. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.